इंट्रा सब कुछ उठाए हर दिन जिताए।
All right, welcome back. You got the market, which has come off, 30 points. That's it. So we are at 18,300. The high was 18,332 on the Nifty. But I think the basic drivers are all still looking very strong. When the IT index opened up 2%, it's up 4%. So from the opening level across stocks, as can be seen from the index, there has been a fair bit of move after the opening, so that opportunity was there after opening as well. What else? I mean, I'm looking at the top gainers. The IT index is kind of the sole driver so far. You got the real estate index, which has come into the mix, but that's far away with about a 1.33% gain. And you got the metals index, which has cooled off a little bit, but still 1.25% higher so far as well. Let's speak with the management of Apollo Hospitals, which has posted a good set of second quarter earnings with a 14% revenue growth, which is well above what the street was expecting. The company's hospital margins have also recovered significantly to around 20%, but blended margins this quarter have been pulled down by the digital health and pharmacy arm. Sunitha Reddy is Managing Director of Apollo Hospitals. She's joining us right now to take some questions. Ma'am, good morning. Great to have you with us here. Appreciate it very much. Could you start by telling us what are the drivers for the sharp sequential improvement in healthcare services revenues and margins?
So in the healthcare services, it was clearly the fact that occupancy improved. We moved from 60% in the last year to 68%. And I think that 8% increase has improved margins. The second is that, we're very consciously looking at asset utilization. The third is there is a cost-cutting initiative. And all this is, the fourth is, of course, case mix. And we will continue to focus on case mix. And with this, we will continue to see a margin expansion. So these are the 3-4 factors that really helped in terms of both revenue growth and EBITDA margin expansion.
All right. Hi, Ms. Reddy. Good morning. If you could give us a sense about the occupancy, what is it likely to be for the coming 2 quarters? And also medical tourism as a percentage of your business, what was it pre-COVID and what has it scaled up to right now?
So pre-COVID in the metro cities, we were 15%. Blended, we were about 9%. Currently, we're at 7%. So I truly believe that, there are many cities where the international flights didn't open up. And with the opening up of travel, we believe that we can close the year with about 10% of total revenues coming from international patients.
Okay. Sunitha, hi, good morning. As always, great seeing you on the channel. Lest we run out of time, I just want to get this out of the way. I know we ask you every single time, but nothing is fructified yet in terms of, long-term interest from investors, your fundraising plans for Apollo HealthCo. Anything in this calendar year itself?
In this calendar, yes. I think by the end of the year we'll be able to share something with you. But more importantly, I think in terms of performance, 24/7 is way ahead of its targets. We had a GMV of 294 crores. And we're on target for 1,500 crores GMV, which is way ahead of the information memorandum. So I think, it's good to wait. These are times that it's better to wait to get a better valuation.
Okay.
And I think that the pharmacy, between the pharmacy and the hospital business, we are generating cash. We have free cash flows of 790 crores plus money in mutual funds that can definitely fund the growth for the next 2 quarters.
You said 1,500 crores GMV is what you're seeing in Apollo 24/7, right?
Yes.
Okay, that's great. You had also, you posted a EBIT loss of around 140 crores in Apollo 24/7. That was last quarter. Have you been able to narrow those losses? And when do you expect to move to profitability?
So we're currently at 170.
Okay.
I think by the end of 23-24, next year we should be EBITDA neutral. And really by 26 we should be profitable.
Right.
But we are on the track to profitability, and I think there's been a growth in the number of registers. Users have moved up by 4 million over last quarter. We are doing 50,000 transactions by day, and absolute bill value has moved up to 1,250 rupees.
Wow.
So the metrics are all good.
Yeah, no, that sounds good. Ma'am, in terms of you gave us the GMV numbers, but what is the revenues that you hope to recognize from Apollo 24/7 for the full year?
It's 20% of less than GMV.
Okay.
Currently, this is what we're looking at.
So since the going is so good in Apollo 24/7, I wanted to understand what are the investments that are expected in the business. Earlier you had said about 550 crores in FY23, and earlier before that there was about 500 crores investments. Since there is fundraising coming in by the end of the year, what would be the total investments in the business, and what could then be the growth potential for 24/7?
In terms of total fundraising, if you look at what we've done and what we've capitalized, I think it'll be about 2,000 crores committed to 24/7. And as you must know, in this business, there's not much you can capitalize. So after the first year, it's all been captured in our P&L. And without any other acquisitions, the number is 2,000. And just going forward, I think next quarter I can share more numbers on where we're looking at revenue, but I do know that next year will be a bit neutral.
Ms. Reddy, what about the average revenue per bed? How do you see that shaping up from year on? If you could give us a sense of what it was in the first half of the year and where's it headed?
Okay, so in the first half of the year, it was about 50,000, and this is not including doctor's fees, which would make it 60,000. And so this is, I think, I think average revenue per bed is a healthy average revenue per bed because it is yielding 25.4% margins, and we were able to, improve our margins by 129 basis points. Going forward, we believe that the case mix will improve. Added to that, when we start getting international patients, we expect to see another 5% improvement in our POB by the end of the year.
Okay. I also wanted, you said that occupancy levels have gone up to about 68%, and this is much higher than what you did in Q1, higher than what you did same time last year as well. Just trying to understand, is it more because of a pickup in medical tourism? Is that something that's a one-off? Is this 68% a one-off or something that you can perhaps sustain?
I believe it's sustainable, even though we did have a lot of medical admissions this year. But it is a sustainable occupancy figure because our target for the year is 70%. And I think Apollo is one of the unique hospitals where we have a high operating leverage and therefore headroom for growth. So even if beyond case mix, I think just increase in occupancy will result in higher EBITDA and therefore higher profits.
Ma'am, if you can leave us with a guidance on CAPEX as well for the rest of the year in 24.
So my guidance would be for 36 months because we are looking at adding another 2,000 beds and an investment of 3,000 crores. A recurring CAPEX for each year is around 300 for replacements, etc.
All right, perfect. Thank you very much. Good luck. Appreciate you joining in with all of that detail. And good luck to you and the business. Well, the market is at 18. You saw a sharp dip, but we're seeing a bit of a reversal emerge right now. And you'll be able to see that on the Nifty intraday, almost back at the day's high, 18,313 that's the one I'm talking about. So it's looking pretty healthy despite the pullback we had over the last 10-15 minutes or so. But I think we have the management of Motherson waiting by.
Yes, Samvardhan Motherson, or SAML as it is called, reported a very good set of numbers. The order book has gone up 13%. The share of electric vehicle OEM components has risen from 27% in FY22, now at 37%. So, of course, it's a higher margin business for them. And the EBITDA has also gone up for them about 50% or so compared to what you saw in the last year. We have Vivek Chand Sehgal, who's the chairman of the company, joining in. We also have Kunal Malani, who's the CFO of Samvardhan Motherson, who's with us. Gentlemen, morning to both of you, and congratulations on a good set of numbers. Mr. Sehgal, I want to start with you. You know, performance has improved across all your key business segments in Q2 in what was a difficult quarter. Across your segments, whether it's wiring harness, mirrors, polymers, your emerging businesses, where are you seeing the maximum amount of traction now?
Thank you. I think, first of all, it's important to understand that what we were saying in the first quarter is now showing the truth. This thing we have discussed a lot with the customers, and price increases and all are in place for this current and for the future also. Also, I think the teams have done a great job in getting very focused on this particular issue. And that augurs very well for the coming third and the fourth quarter as well. Also, third quarter is traditionally our the September end. This thing is always a little bit weaker because of the holidays and all that. So the board actually congratulated the team for a great job done. I think all our products are going to the entire car, but so very difficult to say which one is going to do better. But I think all of them are going to be doing very well.
Okay. Since we have the CFO with us, would be great to get him in and talk about some numbers as well. Kunal Malani is with us. Kunal, the revenue run rate has been pretty solid. I mean, if you look at the bar chart, 18,260 crores is what you did in Q2. On an average, you've done about 14 to 17,000 crores in the preceding 4 quarters. Will this run rate improve a lot more because the order book has gone up as well? What's the executable orders in the second half of the year, and what can the growth look like?
Absolutely, Sonia. Thanks. Great to be on CNBC. Number one, the drivers to the revenue side is threefold. Number one, I think the industry itself has done well. You saw around 21 odd million vehicles getting produced in this quarter. After a long time, supply chain elements have receded, and that has allowed this production to happen. And we have been a beneficiary of that as one. Two, the fact that our products are both product agnostic at the same time are technologically advanced has enabled these product lines to actually feed into the premium end more. And with the premiumization that we have seen happen over the last, I would say at least 2 years now, we have seen that the growth in premium segment has actually been much higher than the base segments. It's also been a lot more resilient to any of the interest rate cycles, etc., that have been impacting the mass end at more levels. So that is, and with our product mix being more catering to the premium end, has allowed us to, in some fashion, outperform the market in that way. And finally, look, our order book this time you would have seen has grown by 13% from 16.1 billion to 18.2 billion. That's the orders which are not in production right now. And for the first time, we've also released what is our total book business, which is 33.9 billion, which will get executed over a period of 5 odd years. And that gives you a lot of revenue visibility on the SMRP BV side, which is reflective of, again, potential growth as we move forward.
Sure. So if you can just help me with one number. On the margin side, you're sitting at about 7.7% margins now, Kunal. Given that you have a higher share of electric vehicles in your overall segment, and you have written in your conference call, mentioned that pricing and realization is on the higher side for EV products, can you at any point in time get to 10% margins in this fiscal itself?
So you know enough, we do not really talk about margins. But having said so, look, first of all, it is 7.9%. That is the EBITDA margin. And when you think about EVs, yes, there's a greater level of content that goes into EVs, and that's why it typically is a more technologically advanced product that gets embedded into many of these vehicles, which should help in improving the the absolute value. That's the piece to focus on because content increase is not necessarily everything that we'll be making, but we will get revenues and margins from it. So the absolute should certainly be improving. The margins can move up or down depending upon commodity prices and a whole host of other contents that go into it.
Hi, Kunal. Good to have you on the show. Let's try to get a number out of you on debt then. It's holding at around 8,500 crores. What's the trajectory on that? If you could give us a sense, say in the next year by FY24, what does that number go to?
So I would say...
Give us some hint at least, Kunal. Some kind of a number.
Yeah, thanks for pushing it. But look, I'm giving you a directional perspective and give you a sense of it. We are at 8,500 crores with both the businesses ramping up, better profitability, and most importantly, a lot of the debt that we have today is driven by working capital expansion. If you would have seen our presentation, it showed in the pre-COVID versus post-COVID levels, we are carrying nearly 2,000 crores of additional inventory. And I'm saying just inventory, the additional working capital is getting played out in multiple different ways. So directionally, as some of the supply chain issues recede, we should expect this to certainly get back into cash. And at the same time, with things looking up, hopefully with our order book where it is. And if other things and other uncertain events don't happen, I think we should be generating significant amount of cash from our operating businesses as well. So we will be on a deleveraging path. CapEx is also, if you would have seen, it's fairly contained. This quarter we did, this half year we've been around about 850 crores. The guidance was 2,500 plus minus 250. We will likely be at the mid to lower end of this range in this financial year.
Okay.
So all that augurs towards the fact that directionally we should be deleveraging. Now, the piece on supply chain is the big one for sure. And that is a little bit unknown just given the environment. But
sure,
as it gets more stable, yes, we should see the reduction happen.
Okay, the supply chain issue is something that's, it's a bit of an uncertainty. But Mr. Sehgal, are you seeing any early signs of a demand slowdown, either in Europe or in the US? I'm asking because of the inflation pressures that are creeping in there. And we've talked about this in the past as to how escalating energy prices have also put a lid on the growth there. Are OEM schedules hinting towards any slowdown at all?
Not to my knowledge. In fact, all our factories, all our companies are, if they produce even 1 or 10 more cars, that's welcome. The customers are for sure looking very, very positively. And the demand, I don't see any slowdown at all.
Okay. Is it also a good time to for inorganic opportunities to come your way, given the recessionary trends in the Europe and US? Are you getting businesses at better prices, and do you hope to close something within the next few months?
Definitely, we are looking at many companies which have been referred to us by the customers. Look, it's a little difficult still. Travel rules are not that 100% clear, but our teams have to go there, meet the people, management discussions and all that thing has to happen. So it takes time. The last acquisition that we did actually took 2.5 years of COVID times, and then also it happened. So I think all these things are around the corner. That would be one reason why our debt, if it does, would go up. But otherwise, the debt would be down, as Kunal said.
Okay. One final question then, if you can talk about the progress in the non-automotive segments that you cater to, whether it's aviation, medical, logistics, any major improvement that you've seen there?
Yeah, definitely. I think 1,750 odd crores has been done by those divisions. But it could have been better. But I think in the coming quarters, coming years, you'll find they're doing very, very well because they've already exceeded what our expectations were. So that's very good.
Okay. Kunal and Mr. Sehgal, thanks a lot for joining in. Appreciate your thoughts. That's the management of Samvardhan Madison talking about how things have picked up quite a bit and they're not too worried about the higher debt. But a lot of stocks in focus this morning. So let's do one thing. Just pull up the chart of Nykaa. There's a big move that's coming into Nykaa this morning. I think there's a double-digit rally. So it would be a little helpful to get that chart up for you. It's come back in a big way. Look at that 16% rally on Nykaa now at 218 rupees. But let's do one thing. Let us take a quick break. On the other side, Mitesh Thakkar will join in for some technical trades. Stay with us.
मैं चाय नहीं पीता। हे एक मिनट, भुजिया के बिना चाय नहीं पीता। पिकाजी है ना? हाँ।
I'm a G, loves Pikachi, loves Pikachi.
My journey of insurance and investments began at the same time when I invested in LIC SEEP. In this fast-moving world, SEEP can balance your funds with security and growth. SEEP will take care of the ups and downs of the market and will give you fruitful results so that you enjoy the ride. And when SEEP is with you, you can soar high.
LIC's unit-linked insurance plan SEEP offers savings and protection so that you can soar high in your life. LIC, हर पल आपके साथ.
Do we have to wait years for a cure?
Hey, Mommy, can we go make some pancakes?
Yeah, let's go. Or are we smarter than that?
To make my vision a reality, I have to see clearly from every point of view. With my Verilux progressive lenses, I seamlessly transition from near to far and see every detail in sharp focus. When you see no limits, there are no limits. Verilux lenses by Essilor.
This tax season, invest in Samco ELSS Tax Saver Fund that aims to create wealth for you by investing in high-quality, small and mid-sized Indian companies. And the best part, also saves tax with ELSS. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
जीत तो इसकी आदत है। टाटा इंट्रा V50 सब कुछ उठाए, हर दिन जिताए।
Welcome back. It's a stellar-looking screen for the market, and it's a very good listing as well for DCX Systems, which is the new debut on Dalal Street. It's up for 42% at about 292 odd rupees. So it's a solid listing in line with what the overall market is doing, which is so buoyant, so very bullish. Well, let's get Mitesh Thakkar on the line. Mitesh, good to have you back. I mean, 270, 280 points higher. Is there a trade you'd want to recommend to our viewers and specific stocks that are moving? What are your recommendations?
Yeah. So, Prashant, we good morning again. We discussed that an opening above 18,200 should attract immediate buying. I think that's there, and the stop loss now should be trailed to about 18,185. Sorry. And on the stock side, clearly traded long bias. IT is something which is buzzing today. A lot of stocks have given a breakout. I think what comes on my radar is persistent systems. That's a buy with a stop below levels of 3765, 3770, and a target of around 4,000 can be looked at on the upside. The other stock which I like is HDFC AMC. We had a buy on HDFC Bank earlier. The AMC stock is breaking out right now, so that's a buy with a stop below levels of 2,100 for targets of 2,200.
Okay, all right, Mitesh, thanks a lot for that. Well, that's a good listing coming in from DCX Systems, as we told you. But let's go to the commodity corner and see what's happening there. Manisha is joining in from the big wall. Manisha, over to you.
Thank you for that, Sonia. Well, as all asset classes are doing well, so is commodities and so is the precious metal prices. I mean, finally, you have seen a big move come in for this one as well, and a second straight month of gains continuing in case of gold prices. So $1,750 per ounce on your screens. Remember, we have done $1,615 per ounce as well in the previous month there. So from there, it's nearly $120 of a jump up coming in for the gold gold prices in last 1 year itself. It has to do with the 2.5% of gains in the overnight markets. The prices are headed for the best week in 8 months, especially when it comes to the gold prices there. The support comes in from various factors. To begin with, it has been about the US inflation that grew at the slowest pace in 9 months at 7.7% for the month of October. That was supportive. And then we did see the decline in US dollar index by nearly 2%. It's trading at a 2-month lows right now. That has been supportive for the precious metal prices. Also, the US 10-year Treasury yields also have slipped to a 1-month lows. And there is now a nearly 85% probability that we are seeing a 50 basis point rate hike in the month of December. That is what the Fed fund futures at least reflect. And that clearly has been supportive. Not just that, there is reports of funds moving out of crypto into gold as well. I'm sure some of those funds are moving into equities as well. But the gold and silver price is definitely taking support from all of that. Not just gold, silver prices gained up by nearly 3% overnight. Platinum, palladium also were up more than 5.5% in the overnight markets there itself. If you look at on a week-on-week and a month-on-month basis, it has been a good performance coming in from precious metals and industrial metals as well. So 3 to 4% of gains for gold, silver and copper. And as you can see on a month-on-month basis also, the performance has been quite well. Nickel clearly outperforming with 13% of gains in this week, 18% up now in last 1 month. Zinc following very closely with 6% of gains in this week. So good going for metal prices for this week as of now.
Okay, there's also rumors that one exchange in China has halted withdrawals on cryptocurrencies, and that's pushing a lot of investors into safe havens like gold and silver. And of course, then there are additional recession fears as well. So safe haven buying continues. Thanks a lot for that, Manisha. But let's get back to tracking equities now. Zomato is a stock on our radar, doing pretty well this morning. Mangalam is right here to tell us who's ordering what. Mangalam.
Well, a lot of people are ordering a lot of things, but the company is not spending as much, and which is why, operational metrics this time around have improved. And importantly, the disclosure of the company have improved as well. Adjusted EBITDA loss, the company believes will break even in the next 2 to 4 quarters, and they've reiterated that. And they've said that they've strategically chosen to trade low-quality growth for better unit economics. So that's a marked shift from, the company's earlier chasing growth at the cost of profitability as well. Adjusted revenue for the company grew by 16.5% quarter-on-quarter. If you account, take Blinkit off, it's just a 9% growth. And adjusted loss also has narrowed from 190 crores. If you take Blinkit off, it's just about 60 odd crores. Importantly, the food delivery business has broken even on the EBITDA front. So, last quarter it was about 113 odd crore in terms of loss, and now it's become 2 crores. And the reason why the company's disclosures have improved is because earlier they had some unallocated costs, and that improved their operating performance of the segments. Now they've begun allocating that to various business heads, and most of them have come into the food delivery business itself. And despite that, the company has actually seen a break even in the food business. Why is that? Because the contribution margin of the food business has come in at 4.5%. The management believes that this is sustainable. What's working for them? Now that a lot of people know about Zomato and, operational metrics are doing well for them, they've seen lower ad spends as a percentage of adjusted revenue. From last year to this, now their ad spends are low by 900 basis points. So that explains improvement. And quarter on quarter as well, delivery spends as a percentage of adjusted revenue is normalizing to around 28%. The company has almost 12,000 crore of cash on their books, and they say that they're confident that shareholders will stop attaching zero value to Blinkit. So going forward, maybe that Blinkit play will come by too.
Something there, right? Bangalam, thanks very much for that. Now, Muthoot Finance is the other one. It's lower for the third quarter in a row. Numbers have been a miss. Abhishek is here with more. Abhishek.
Well, as I mentioned in Fin Street, earlier that NBFCs are losing customers to banks in terms of the gold financing. This continued for Muthoot Finance for now 2-3 quarters in a row. So they are losing customers to banks. AUM growth is one of the lowest that you are seeing in last 20 quarters on a YOY basis, coming in at just 3.8%. The gold AUM growth is just 3.3% YOY and about 0.6% sequentially. However, the gold customer base has declined by 3.84%, which means that the average ticket size is actually aiding the AUM growth over there. So net interest margin has improved by about 30 basis points sequentially, largely due to the fact that they have been able to control their cost of funds. So subsidiary performance is also weak. A housing finance subsidiary is under pressure on growth front, especially so in 7 quarters in a row. They continue to lose customers as well, both YOY and quarter on quarter, which is impacting their AUM, which has declined both YOY and quarter-on-quarter. The MFI subsidiary, that is Belstar, that has seen gross NPA rise for 3 quarters in a row, now at 8.5% versus 7.3% in the previous quarter. So in terms of PNL, both the NI and PAT is a miss, and CLSA has written on Muthoot Finance the underperformance rating continues with a target price of 1200 per share. They have cut the EPS estimate for FY23 to 25 anywhere between 7% to 8%. Back to you.
Okay, thanks a lot for that. That's Muthoot Finance. GNFC also on our radar this morning. Sonal is here to tell us why. Sonal.
Well, GNFC is declining on the back of very weak set of numbers. Overall revenues were down 4% for the company. EBITDA declined 28% to come in at 310 crore rupees. Margins at 12% versus 21% on a YOY basis, leading to a profit decline of 16% to come in at 237 crore rupees. Now, company has two segments, fertilizers and chemicals. So their fertilizer segment did really well this time, and the company says it was aided by better sales volumes on a YOY basis. However, the chemical segment, that is the one which did not do well and led to this margin decline. That is where they saw subdued realizations this time around. Sales volumes were also impacted because of an operational outage at their Bharuch complex in July 2022. So overall, weaker realization and volumes is what impacted company's performance this time around.
Okay, thanks a lot for that. So we're also watching out for Eicher Motors. Now, if you're wondering why the stock is down, despite a good set of numbers, the numbers were good. There were no problems over there. But on a quarter-on-quarter basis, the margins are lower. That's because of a higher mix of the low-margin Hunter products. So they sold more number of Hunter bikes, and the margins fell 112 basis points on a quarter-on-quarter basis. Now, we need to monitor if the scale increase and cooling raw material prices could offset the margin dilution because of the higher Hunter sales. So if the Hunter sales continue to increase, which is of course a good thing, it may compromise on their margins, and some brokerages believe that it's fine. It's good that they are, they are perhaps looking to grow on volumes and maybe sacrificing margins for a bit, but the stock is under pressure because of that. Morgan Stanley says the upside to FY24 consensus EBITDA per unit and margin is limited, and the valuations also look full at the moment. So these are some reasons why Eicher is under pressure.
All right, 3571, 3.5% lower. We'll take a very quick break here. The market's cruising along nicely, 280 points. On the other side, we'll have Puneet Chatwal of Indian Hotels joining in to discuss their second quarter earnings performance. Stay tuned for that conversation.
What is the current status of our cyber robbery?
Little bit playing tricks.
Alluring them a little bit.
Tempting them a little bit.
After that, their all money will be ours.
Our little awareness can stop their laughter and cunning tricks. Do not use unauthorized apps, unknown links, and don't allow unsecured Wi-Fi connections. If something wrong happens, report the matter immediately on helpline numbers.
आग को फैलने से रोकना मुश्किल है, पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाई क्लब प्राइम आग से बचाए।
घर का खर्च चलाने के लिए रोहन की पढ़ाई वाली एफडी तोड़नी पड़ी, और उसके डॉक्टर बनने का सपना भी। काश तुमने जाने से पहले टर्म लाइफ इंश्योरेंस लिया होता।
PolicyBazaar.com पे 1 करोड़ का टर्म लाइफ इंश्योरेंस सिर्फ 430 रुपए महीने से शुरू।
एक वक्त था जब हम घड़ी सिर्फ वक्त देखने के लिए खरीदते थे। आज धड़कनों का हिसाब भी घड़ी रखती है। फोन खरीदते थे कि अपनों से बात हो जाए, पर आज पूरी दुनिया फोन में रखते हैं। घड़ी हो या फोन, वक्त के साथ सब कुछ स्मार्ट हो गया है। और आपके घर खरीदने का डिसीजन, क्योंकि आप सिर्फ घर नहीं चुनते, आप चुनते हैं अच्छा आस पड़ोस, बेटर कनेक्टिविटी, बेटर कंस्ट्रक्शन, और सबसे ज्यादा जरूरी, टाइम से पहले डिलीवरी का भरोसा। तो करना है अगर अपने घर का सिलेक्शन, सिग्नेचर ग्लोबल है ना, ले लीजिए स्मार्ट डिसीजन।
इक्विटी में इन्वेस्ट कर, ग्रोथ का है चांस।
डेट में है लो रिस्क, बात मेरी मान।
गोल्ड सिर्फ गोल्ड, भैया ने भी यही किया।
सुन सबकी, कर मल्टी, मतलब मल्टी एसेट एलोकेशन फंड्स, यानी 3-in-1 फंड। ये इक्विटी, डेट, गोल्ड तीनों में एक साथ इन्वेस्ट करें। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेज ध्यानपूर्वक पढ़ें।
Welcome back. 280 points, right? I mean, around the day's high on the Nifty, 18,311, so 20 points off it. So it's a super day on the back of what we've seen overnight in global markets. And the one sector which is doing very well is the IT services space. The index is up 4%. Large caps are up 3%, 4%. Mid caps are up even more in the range of 6 to 8%, depending on what you want to look at. Outsized contribution coming in from the IT services space. The next management on our radar is always an interesting one to look at and speak with. Indian Hotels is what I'm talking about. They've continued their streak of strong results. Occupancy has risen to 70% this quarter versus 68% pre-COVID. The company's average room rate has also continued to trend higher. Currently over 11,000 rupees as compared to about 8,700 rupees pre-pandemic. Puneet Chhatwal is Managing Director and CEO at Indian Hotels. Puneet, it's always a pleasure. Great to have you with us here on the program. Prashant this side. So, I mean, the overall sort of trend improvement continues. But I want to start with perhaps a bit of a near-term issue, which is margins. Margins seem to have missed expectations. Revenues on a quarter-on-quarter basis are largely steady, and Q2 arguably is a softer quarter. But on that same revenue base, costs are slightly higher, staff costs, other expenses, etc. If you could just explain that, start there. Go on.
Thank you for having me. I think the margins keep increasing with the revenue. The flow-through becomes 100%. So I think what we are missing is a certain percentage points because the rate flow-through is not the same as was in Q1. That's one. The second is a one-time adjustment in the cost because this is the quarter in which we give increments to the staff. So you see a certain uptick in those costs. And on the total margin outlook, we remain confident of delivering 33% over the business cycle as the guidance we have provided under our strategy of Avan 2025. That we will do 33% margin. Now, traditionally, Q2 has never exceeded 17%. That was only in 1 year. And the average in Q2 has been more like 13, 14%. So I think a 25% plus margin is something for Q2, which is the weakest quarter, we think is a very good number. And we had to make certain investments in sales and marketing, in our digitization, in our loyalty program that we aligned ourselves with Tata Digital, with the Tata New app. And those investments are in line to secure the long-term margin and the long-term profitability and the future of the company.
Right. We take that point, Puneet. Thanks a lot for joining in. Mangalam here. Just wanted to understand, you said Q2 is seasonally extremely weak. Are we looking at a record Q3 quarter for the company? Because that is one, seasonally strong. And secondly, just a cursory glance at any of your hotels, bookings, etc. for the holiday season, prices are shooting through the roof. Just wanted to understand what occupancy trends are looking like. And are we on track for perhaps a historic Q3 for the company?
Actually, it's interesting, Mangalam, you say that because Q1 is a historic Q1 this year. Q2 is also historic. And what the first 6 weeks of this quarter suggest, there is nothing which stands in the way of Q3 also being historically the strongest quarter that we have seen in the last 10 years. So with the business on the books, with the way business is picking up, and the trends, especially for the month of December, Christmas, New Year, we do think that the sector will finish on a very good note. And being the largest hospitality ecosystem, we are very well positioned to get the benefit of that.
Puneet, H1 revenues, the first half revenues are about 2,500 crores. Q3, I mean, it's interesting the way you described it. Each quarter so far has been historic in its own right, but Q3 is the strongest in an absolute revenue intake perspective as well. So what should we expect for the full year with 2,500 crores in the bag in the first half?
Well, I would just say if we go back on a historic base from pre-COVID, not during COVID level, 40 to 45% of your revenue comes in H1 and the remainder comes in H2, with Q3 being the strongest and Q4 being the second strongest quarter. So I think that math makes it pretty clear, and the consensus of analysts is what we should follow. But yes, Q3 and Q4 were and will remain, also with the, the incremental demand which we'll get through the return of the international travel, people coming into India, as well as the G20 kicking in with government delegations. We do believe that Q4 will also be a very strong quarter.
We take that point, and basis what you've said, assuming that what you've done in the first half of this year so far is about 45% of your annual revenues, you are likely to do about 5,500, closer to 5,600 crores on a full year basis as well. But I just wanted to understand, there has been a bit of a topping in terms of the way the stock price has reacted for Indian hotels. Of course, that is not to do with the way you manage your business, but does the market know a little more, in the sense that are we expecting this growth that we've seen in the hospitality sector to at some point now peak out, and maybe the early bird has been taken away, or the early cream has been taken away, so to say? Or is there a longer runway?
I personally believe the best is yet to come. I think we're still at a very low end in terms of average rates in luxury properties. Yes, they have gone up because it's not a fair comparison to the COVID times rates. Most of our luxury sector is still at around, $150 to $175 average. A similar style of hotels, firstly, don't exist, but in other markets west of India, you're charging anything north of double that amount. So we may not be able to charge double, but at least definitely 20, 25, 30% higher rates should be possible at the top end of the market.
20, 25% higher rates from here for...
From here should be possible. I mean, it should be possible because $150, if you take that as a base,
right,
then it's getting to $200 is not very high for a Taj Mahal Palace, kind of properties that we have on an average.
Right.
So some hotels still do around $200,
right,
but some others do only 120. So the 200 could go to 250, 120 could go to 150, 150 could go to 200. That would be a normal increase, which I think the sector has been waiting for the last 10 years.
Right. Okay, that's interesting. Actually, that was my next question, because when we look at the average room rate, but the contribution of the topmost, most premium properties would be outsized, right? In terms of the revenues that you take in. And you're saying that some of the other properties may also start to see tariffs moving higher. But is there any signs at all of those price points hurting, or you think that's not going to be an issue at all?
I think the ability to charge comes from a competitive advantage that you have in your brands, in your locations, and in your product. And I think the way our brands are positioned, we have always had the ability to charge. As an example, our revenue growth index compared to the market is at 1.5 pan-India basis, and in some markets is more than 2. So on an average, for us to expect 30% more with the Taj brand in any given market is almost a given. So I do believe that the positioning of the brand, the kind of competitive advantage a brand has, helps you in your ability to charge and to charge a premium.
Would you have a glide path for this 33% target that you have in terms of EBITDA for 2025? You've done 25% now. Can we expect, say, 29% in the next year? Just splitting it arithmetically, can we expect that sort of growth in your margins? And in that itself, I wanted to know, from pre-COVID to now, what proportion of cost savings, according to you, are sustainable?
Well, Bangla, we can't look at a quarter, and as I said, Q4 being the weakest. In Q1, we did 31%, in Q2 is 25%. So for the first half, you're already at 20, 29. Q3 will be very strong. So I think Q3, Q4, if you look at it, will get closer to, more like a Q1 number that we have had. Mathematically, that is what should happen, given whatever business we have on the books. So that Q2 is not the base for the full year. Q2 is the weakest base for the full year.
And as far as cost savings from pre-pandemic is concerned to going forward, and also ancillary revenue streams that you've got, which obviously would have much higher flow-throughs.
So there are three things here. Firstly, our corporate overhead should go down from more than 8% to almost 6% as a percentage of the top line. Number two, fixed costs have gone down from 46% to 38%. I think that's a trend that is going to continue. And finally, our new businesses that we have added in terms of homestays with the Ama brand, Human as a QSR and home delivery, and Ginger we also include in the new businesses because the name is old, but the brand is totally repositioned, is already done 39% EBITDA margin for the first half. But there is still a long way to go because the positioning of the newly positioned or newly reimagined Ginger brand for the Lean Lux properties is north of 50% margin. And as we spoke last time, all the new businesses that we are doing, we're looking at an EBITDA margin of more than 35%. Otherwise, we don't enter into those businesses. So the traditional is the one that drives the absolute numbers, the top line,
right.
And the amount of EBITDA, and the new businesses drive the percentage of the margins that you're seeing. And as a big change, we are historically coming from less than, as I said, 17% margin, which was the best we did was 1920.
Q1 was historic, Q2 is historic, and Q3 so far is turning out to be historic as well. And given what you've said, I mean, you should be on track to do about 5,500 crores in total revenues for the full year. So that's Indian Hotels for you. Very, very confident. And, tariffs can be moved high by about another 20-25%. So confident commentary.
Confident commentary, but it's interesting. Tariffs, if they're higher by 25 to 30%, everyone in the consumer space is speaking about inflation actually pinching consumers. So let's see if at some point it will start to hurt, because you're now thinking twice before booking that holiday, flight expenses,
sometimes thrice,
sometimes thrice as well. But just a word on the way the stock is reacting in today's trading sessions, down almost 5% despite a good set of numbers. A part of that could also be on account of some pre-positioning that had taken place ahead of the MSCI inclusion. And now that announcement has come, maybe some bit of unwinding. But no such problems for the markets.
For the market, absolutely, Mangalam. 270 points, 18,300 is where we are at. So super strong. It's a wrap on Bazaar from all of us here. Thank you very much for staying with us. Lots of trading ideas lined up here next on Chartbusters. Up in just a bit.